Rob's Child here with another chapter of Security Analysis, Chapter 11. Nothing I say is investment advice, and I have no intention of replacing the value and the contents of this book, but supplementing it and opening a discussion about it. If you are a serious investor, you obviously will be reading this book in its entirety. So today we're going to talk about Chapter 11. We're continuing with specific standards for bond investment. And this chapter covers the relation of stock capitalization to bonded debt. So, I know a pretty good amount about securities, but, I didn't know about these ratios and how they worked, and so I did some online research to help me understand some of the things in here. But anyway, we will so my recommendation for anyone reading this, if you don't understand what something means, try to look it up. Use ChatGPT. I use ChatGPT to help me understand how these things work. So let's go through the main points here. As the subtitle says directly, this is all about how we can use this information, the stock capitalization, so the supposed value of, the market cap of a company compared to how much debt it has. So let's just go through the main points. So on 147, I'm going to start with this quote right here. He says, quote, "Before paying standard prices for bonds of any enterprise," it talks about railroads, and then continued, quote, "the investor must be convinced that the business is worth a great deal more than it owes." So I think this is a pretty important point to understand and to kind of grasp. For a bond to be legit and to be safe, a safe place for you to have money earning you more money, the business obviously needs to be earning a lot more than what they owe. So you have to have that in mind if you're buying straight bonds. Again, not a lot of people do this. I think that are looking for individual bonds out there. But I mean, then again, I hear about some of these famous investors on TV recently talking about the deals and some bonds that they were able to find, and so I think the experts really do care a lot about bonds and how they work, and so it's worth learning about, obviously. So one point he brings up in here is that everything is basically qualitative outside of current assets to current liabilities, the going concern idea. So that's one big point I think he makes in there. And then really one of the biggest takeaways here is the stock market price and how it matters for bonds. So, if the market is valuing a company, the total company, a lot lower than what the company owes, that's a major problem. That says that, again, at the end of the day, yes, the stock market is a voting machine, not a weighing machine. We picked up that idea very much earlier on, but it matters because it's the amount of confidence. The stock price represents the confidence people have in the company to be able to make money and how much money, And so this seems to be one of the main ideas that he says for the quality of bonds. And of course, he talks about how stock prices can go up and down, and so you obviously have to combine that with earnings and the average earnings of the past 10 years, and you do have to consider the future. How can this company continue to make good earnings? And again, we go back to a rule that he talked about earlier, how you want to make sure your company is able in normal conditions to be earning double the amount of interest they owe on their debt. And that gives enough of a cushion that when there is a depressed time, they can still pay their debts. And then when they're not paying debts, it's a money making machine that you own. So okay, another huge point here. This book, this edition, the second edition, which is supposed to be the golden edition, as far as editions of this book go, from what I understand, there's not a lot of different kinds of industries at this point compared to the amount of industry categories that we have today. But here we're talking mostly about railroads versus utilities. It's like those are kind of the two giant categories. There was no NASDAQ, there was no internet companies, there was no, all these kinds of things. So, but anyway, the point is that he illustrates, numbers in here that, how much, at the end of the chapter, there's a chart that sums up how many times the earnings should be of the interest payments that the company owes. And, that depends on the type of industry it is in. And different industries have different margins, basically, is what we're talking about. I'm sure you've heard other YouTubers on talking about margins, and I've mentioned in other videos too how, also Kathy Wood, I've heard talk about this, how we've been in a period where she says, this is an effect of market efficiency. The more efficient markets get, the smaller margins have to be. But at the same time, it causes more potential pain, whenever there is a downturn, whenever there are depressed conditions, and, when companies are so competitive against each other and, driving that earning power above interest charges to be smaller and smaller and smaller as time goes on, it's a little frightening, really, as an investor. I mean, the way I look at it, But so it depends on the industry, and I'm sure that this applies to today. So obviously, certain types of companies, you're going to need a guarantee. You're going to basically want to have in your head, like, well, this should be the ratio of earnings to interest charges versus a different industry. It could be a lot more or a lot less depending on sort of the volatility of the industry. So, I think it probably has to do with how new the industry is too. So anyway, these are all good things to think about. I'm going to pause for a second. I'll come back. So in the end, he mentions again how income bonds are, I don't even know if they make income bonds anymore, but they function sort of more like equity because they don't have to pay. It's not interest payments. They're more akin to preferred shares, but the principal gets assumably paid back. Actually, I should look up. Yeah, what is the difference between an income bond and a preferred shares? Oh, well, that's right. They're forced to pay versus wanting to pay preferred shares. If they have available earnings, they have to pay the income bonds. That's the difference. Okay. Anyway, I digress. And then we bring up again, the value of the stock to the debt. And he says, obviously, that shouldn't be the only thing that you consider. You do need to calculate yourself, what's the earnings power of this company in the past, right, in the present, and in the future. But he does seem to agree that the value of the stock really matters. One other suggestion I want to bring up that I think was important that he said was, if you're looking at a highly depressed bond value, along with a very depressed stock value, obviously the market is calculating in a much higher risk of bankruptcy. And he says, yeah, you can get that gain of the bond if you buy bonds in this depressed situation, but it's not always smart to do that. You're probably better off getting the stock in some cases. And of course, you have to read the chapter to get all the details. He compares these two companies in a very interesting way to get you to think about how these things work. So that's all I have for you for this chapter, chapter 11. Please discuss anything regarding this chapter that you'd like to discuss in the comment section below. Thank you for tuning in, and I'll see you next time. Rob's Child.